fundsupermart.com.
Hi Stephen. The strong performances of global bonds have surprised investors this year. What were the drivers of the outperformance, and is this outperformance sustainable?
The strong performance of global bonds this year has been driven by a combination of declining interest rates as well as spread compression. What's causing the decline in interest rates is really a combination of concerns about global economic data being weaker than expected, as well as the fact that there are concerns about geopolitical tensions that are taking place currently. We believe that this level of outperformance is unlikely to be sustained in the second half of the year, and returns will be more challenging going forward. In large part, this is also due to the fact that the U.S. Fed will commence its path toward normalizing its interest rate policy.
What is the growth trend like for fixed income in second half of 2014?
There's ongoing demand by investors for fixed income products, and that demand is across the board. For investors who are looking at fixed income as a safety component of their portfolio, there's strong demand for U.S. Treasuries because while rates are low, compared to other risk-free assets such as German bonds, U.S. Treasuries still look attractive. The second component of fixed income demand is in the area of yield, where yield-seeking investors want some credit risk exposure, and we see that ongoing demand. And then finally, within the yield curve itself, we see very strong demand, particularly from pensions, for longer dated maturity fixed income as they seek to match their liabilities in their portfolio.
With bond yields falling, where should investors search for yield?
Investors can obtain yield in fixed income really in two core areas. It's in the form of taking increased duration or interest rate exposure or credit risk exposure. We believe that in the current market environment, it's more favorable to take credit risk over interest rate risk sensitivity. But having said that, we believe that as the market starts to turn a bit more bullish, that a little bit more caution is in order.
What type of bonds do you favor more within the fixed income space?
As I mentioned previously, within the fixed income area, we favor credit components over interest rate components. So bonds having credit exposure or credit spread yield. So that would include areas such as U.S. investment grade credit, emerging market corporate credit, and bank loans in particular, because bank loans provide a combination of both credit yield enhancement, but at the same time have interest rate protection. And then within the yield curve outlook, we like a barbell approach. And so what that means is that we prefer long-dated assets and short-dated assets. But we want to be very careful about the intermediate, or what's called the belly of the curve, because we believe that part of the yield curve is most susceptible to changes in monetary policy as we ease out of the quantitative easing and monetary policy toward a more normalized interest rate environment.
Thank you.
Thank you.